this is only the fifth time in the last 154 years that we've had a significant decrease in the money supply. We have in the last, looking at the stats, we've had over a 2% drop, which doesn't sound gigantic, but it actually is very significant. The last time it's occurred in that size was in the 1930s in the US.
Long ago.
Yeah, it's a big deal what's happening. So this is the fifth time in the last 154 years. The other three times also resulted in significant disinflationary cycles with huge increases in unemployment. So we're coming into this scenario here with what I think are extremely inflated equity valuations, partially inflated. Well, they're inflated for lots of reasons, but let's just say they're inflated. Okay. I think it's fair for me to say that I don't believe the earnings are going to possibly justify this when I discount them back.
Wouldn't expect so.
No, but when I look at, so what's the scenario here? If we have, well, that's part of it. The other part is we have a significant contraction in the lending processes from the banks. They've tightened credit effectively, again by a significant amount, over 2%. The last time we had that big a decrease in the or increase in credit restrictions or decrease in willingness to lend was back in 2001, right before everything went to hell with the markets. So what I would say is the Fed has a problem, serious problem, because the employment market's still tight. I actually call it robust. We're sitting near all-time lows in unemployment. We have, I think, decreasing earnings coming in, because what will happen is as inflation is coming down, but that'll be coupled, I think, with some serious disinflationary cycles, or pressures, which will drop the earnings, which will increase unemployment, which will lead to what I believe will be a major adjustment, we can call sell-off adjustment in many asset classes. I think it could be a scary time, coupled with all the political unrest that's going to come from what's going to be a very interesting election here in the U.S. I'm not stating any views on the election. All I'm going to do is quote one of the former advisors to Trump, who said that he sees this election as choice between dementia and the demented. So I
like that.
It was a little harsh, interesting, but it's, so we have significant political risk here. We have a possibility of the leading guy in the polls not being able to run because of, you call it criminal issues or political issues, whatever you want to call it, but that's possible. That would probably lead to, I would bet, to serious social unrest, probably have riots and violence. If he wins,
Again,
worse than we've seen. It would be really, I mean, we have a divided country in terms of the political stance, and it's divided sort of both on I would say in terms of obviously political views, but also largely divided by economics and age. So it's the demographic. It's very strange. It's a very strange period. We're going to have, I would say, hyper volatility over the next 12 months and probably the next 2 years. I think the stock market, what we saw into the end of last year was, I thought we would have early this year. I thought the market would be a little more tame coming into year end, have a little correction, then go make new highs. We made the new highs earlier. Everyone got sucked in. Now we're seeing the initial sell-offs. Depending on how things play out, depending on earnings, depending on a variety of things, we could start a major bear market here in stocks. It's early to call it, but given what I'm seeing with money supply, given what I'm seeing with credit stance of the banks, given what I'm seeing with the, I say, overexposure, over optimism in stocks, yeah, we could have a major sell-off there. In terms of the dollar, it's mixed. If the U.S. really starts going into a bad period, that would probably have some, at some point that could lead to major repatriation of assets by Japanese and by others. The Swiss franc's in its own little world here. It's like people are buying Swiss francs. It's certainly not for the yield. And it's interesting that people are happy to sell yen for the yield and buy dollars or buy any higher yielding currency, but they're buying Swiss francs with almost the same yield. So there are a lot of strange things going on here. Technically, I still like gold. I think gold's on its way to new all-time highs. Could that change? Yeah, it could change. If we go into a major deflationary cycle, then the price of gold could actually come down, but its value could be going up relative to its purchasing power. So it's early in the year. This is probably the worst start to a year for the equity markets that we've had in decades. And this is a terrible start to the year. And a little bit of bad news, and it's going to get very bad. Because people are kind of stuck and they're like, oh my gosh, it's, the so-called January effect doesn't seem to be working this year.
Yeah.
And bonds are a mess. I mean, we got the big squeeze up to 518. I thought we get to 530. Okay, I missed it, but we did have
pretty close.
It was pretty close.
You were saying that a long time ago when it was very far from there.
Yeah. Again, I was looking for sort of, okay, I don't believe markets repeat themselves or history repeats itself, but I think it rhymes. And I was looking for a rhyme. And for me, the rhyme was 2007, where everything basically fell apart with the yields up around 530 to 540. And then everything fell apart. That's in the long bond. So we basically almost got there. Close enough.
Towards the start of the year, you were actually saying 5.2, and then it was 5.3 after that. So technically, you were pretty much there. Yeah.
Yeah, we pretty much got it. One of the things I wrote about in my last write-up was the fact that I tend to be early. And it's probably the main reason I like to use options, because once I sink my teeth into a view, I don't like to let it go. And the process of picking my views is a strange combination of a variety of technicals, fundamentals, intuition, gut, whatever you want to call it, and then finally I fixate on some theme. What I intend to do, like with my students in the classes, is walk them through all the different components that I look at and help them understand that, it's not just momentum and it's not just divergences or whatever we might think of looking at in technicals. There are time components. There are all kinds of different things that go into my little cauldron where I'm cooking all this, this sauce. But ultimately, I mean, for me, the best risk reward that I can create is going to be through well-structured option plays. I don't have to worry about getting stopped out. I give up a lot in the sense that I'm not going to be in at the tops and bottoms in terms of my break-evens. But if I'm right in the big picture, it works great. I can never create a risk reward with spot quite as well, with quite as much comfort, knowing that I can never lose more than X. With spot, you have unlimited downside. It's symmetrical. So it's, I guess with stocks, okay, it's asymmetrical because stocks have, what is a stock? A stock is basically, it's a call option with no expiration date. I don't know that people think of it that way, but that's what it is. It's a call option. You can't go lower than zero, and you have unlimited upside. So that's the call option.
Speaking of stocks with options, since you've said that you're expecting some sort of bigger move to the downside, whether it's now or later down the line, not sure yet, but right now it's at this sort of, I guess, critical level where it's either going to push up to new highs or it's going to have a bigger correction. And I guess this is the ideal sort of situation for options as opposed to trading spot, because you don't have to be exactly right with it being right now, as long as the move ends up happening.
Absolutely. So in a scenario like this, depending on the levels of volatility, and this, again, this is the sort of thing that I'll be teaching. If volatilities are low and attractive, I might just structure a purchase or a put spread, for example, if I'm bearish. If volatilities are higher, depending on the shape of the curve, if volatilities are very high in the short term and lower in the long term, I want to sell the short term, buy the long term, and I structure a play where I make lots of money if we grind down towards my target or if we go fast towards my target. Either one works. So there are certain trades where it's, I'll call it sort of 2-to-1, 3-to-1 sort of payouts, but a high probability. Other trades which are 8, 10-to-1, 15-to-1 maybe. Lower probability, but not as bad as you would think to get that kind of risk reward. The opportunities, and my favorite time to play a market is after a compression, okay, or after a market makes a new high and then fails to hold it. So NASDAQ is setting up beautifully for all kinds of interesting trades. Make a new all-time high and then it just falls apart. That's interesting. There's a lot to do there, a lot. And my idea is, give people the tools, help them figure out first how to really identify the opportunities, read the markets. So there's a lot of work on reading markets and doing assessments there and trying to do forecasting, and then trying to create trades which have a great probability of getting a positive return, but not having just one or two bets, but ultimately diversifying the bets. So it's, but this year should be absolutely wild. Look, we started off the year in pretty violent fashion in multiple markets, so I don't see that changing.
Yeah, you said that this year is going to be a high volatility year. Just going back to the options thing, so one part of it is someone would need to have a market view, like the stuff that you've just been discussing with stocks and the dollar and so on. And another part is actually being able to understand or have the skills to be analyzing the correct things for what's specifically relevant to options. That it's not just about having a market view, it's also knowing about how to structure the trade correctly and the best way to do that to maximize the opportunity or to align with your view. So these are things that people learn in the class.
Exactly. So like one of the things that I don't understand why exactly, but historically, if I look at the patterns, for example, in the currency pairs, they tend to trade over time at certain average levels of volatility. So for example, dollar Canada tends to trade about a 6% average annual volatility level. It just does. When it gets into the 3s, 4s, I might just buy straddles and I don't care. I don't have to have a view, because coming out of that compression, we're going to have a big move. Because to get to an average of 6, if we're trading at 4, it means we have to get to 8, which means it's moving twice as much over some period of time to get to that average. Dollar yen, same thing. When it gets down to the 7s, I want to buy it. When it gets into the 13s and 14s, I want to sell it, or I want to structure trades where I'm not betting on increases in volatility. And dollar yen has very asymmetrical types of volatility patterns. So, for example, when the market's putting on carry plays, the moves higher in the dollar or higher in the yen crosses tend to be kind of calm, kind of boring, grinding along. So volatility tends to get compressed as the trend is going. But when the trend reverses finally, volatility will typically explode higher. Number one, you have a lot of people bailing on their positions. Number two, you don't have the same constant demand for dollars versus yen from speculators, because they'll be going the other way. They'll be getting out. I think back. One of the most interesting periods was the I guess I go back to 1998, where, everyone was bullish on dollar yen. They were all talking about 160, and they had a big interest rate carry play going on. And, Rubin came out, I guess maybe it was in September, and said, no, dollar yen at these levels is too high or unsustainable. And dollar started to break down from 147 down to 142, 141, 140. And then we broke some trend lines. And then the end of the move was actually, it was sadly one of my clients who had refused to get out of the dollars that we had big fights about it, actually. I flattened out around 142. I said, you've got to get out. This is done. He said, no, it's going up, going up. So the finally came in when it was around 123. If you look at the chart, you'll see a move from 123 to 111 within a few hours. And that was him bailing. And it was very painful.
Ugly.
It was ugly. It was a very big position. But and that's where I sort of got this thing. It's like, up the stairs, down the elevator. That was down the elevator shaft. It wasn't the elevator. And if you look at, and so could we have that kind of move here, for example, in the yen or the yen crosses? Yeah, we could. I would say the short-term speculative market is probably a little bit long yen on a variety of things, but the big players are short yen. And those are the guys who, they're like, well, I'm going to make my 3 or 4% just getting my carry if nothing happens. And they'll tend to sit on it and wait. If we start breaking certain technical levels, they'll bail. Or if we get certain fundamental shifts, then they'll go, okay, it's time. But that's the kind of, just that initial unwinding, not even positioning the other way, could get us from, let's say, 144, 145 to 130. That's the kind of move we could have very quickly once it starts to go.
Your thoughts of the market just before Christmas, I think it was like midway through December. The title was Up the Stairs, Down the Elevator as well. And you'd called the initial sort of big move that happened. Then we've kind of had this, to start the year, a bit of a correction, but Friday's activity was, interesting to say the least.
Yeah.
But you were saying that you expected some sort of correction, like
I was looking,
bullish rally.
I was looking for a bounce. I mean, that's why I wrote about it at the very end of December. I said, this is extended. I felt like there wasn't, number one, it was getting way oversold in all the technical indicators that I look at. I go, we need, I thought it would be anywhere from 3 to 5 days of corrective price action, maybe a bit more. Elliott wave wise, what would they say? Well, maybe that means the move down to 140.20 completed the first leg down from 150, 190 or so. We did almost a perfect 50% correction of the whole move. And it just stopped just short of the 50% level and got pretty aggressively rejected. I think the market, what's been going on, the market got ahead of itself thinking the Fed is going to just start pumping money into the system again. They can't start pumping money in the way they want. It's a little early. It's not like we don't have inflation way above the target. And I've written about the insanity of a 2% target anyway.
Yeah.
I mean, it makes no sense. It was an off the cuff remark, and it gives the authorities a chance to make things look better than they are. That's all.
The 2% is arbitrary. For anyone watching this, there's an article on Andy's blog about the 2% insanity, the insanity of the 2% rule. Speaking of the Fed, you, in your last write-up, you're kind of disagreeing with the consensus. So what are your views on interest rates for this year, or at least let's say the start of this year, the first few months?
Well, I think the market is probably right overall that we've seen a high in rates overall, unless we have either some kind of macro crisis where people don't trust the U.S. government enough to cover its debt, that's a bigger picture issue. I don't see that yet. Say yet.
But you say yeah. I was gonna say.
But I think more likely by thinking about we had this the move from 518 down to whatever, just below 4% in the 30-year. Yeah, we're getting a bounce. We had a pretty fierce bounce. Was it enough? It was probably enough price wise, but now I think we're going to chop around. So I think overall the downside in interest rates is more interesting than the upside in terms of yields. But I think we're going to muddle along with the Fed not doing much at all. I think they're going to just kind of wash and go, oh boy, what do we do here? Because if we start getting some real bad numbers, if the economy starts turning negative, how much money can they really put in the system? Inflation can come back very fast.
Well, it's not completely gone, so
it's certainly hardly gone. We're still looking at about a 4% rate here. UK rates, inflation is very high. Europe is amazing. If I look at the continents, like, inflation is still high, growth is awful. Interest rates are still relatively high from where they were, and the banks are still tremendously underwater. They accumulated trillions of dollars of assets with interest rates lower than here, but they're just kicking the can down the road and hope that things get sorted out.
Magically, it's going to happen by itself.
Yes.
So going back to gold, because you said about you're early with some of your calls, but with gold, you were pretty much spot on with both directions. Are you waiting on the sidelines now, or do you have a view on what's going to be happening now with your magic gold crystal ball?
So when we spiked down below 2000 on the recent move, which was a necessary correction, it stopped almost exactly where it was supposed to stop, which was, again, I like Fibonacci levels, sort of. Okay. And in retrospect, they're always great. but but I was looking to get below 2000, squeeze out some longs. And so I still had my puts from earlier, and I basically rolled that premium into new call options. So I managed to,
cool.
Yeah, so I basically caught the move down, caught the move up. I flattened, and now I'm just long some call options again. So I think that, my original target was like the 2250, 2300. It could be more. The only thing that makes me a little nervous about the idea is that I'm not sure how I combine my frightening view on the U.S. economy with slowing numbers, softening growth, worsening unemployment by a lot, with higher goals. So that's a little puzzling to me. I think it's possible because it could be the safe haven that people run to, but they don't know what to do. And Bitcoin, which has no intrinsic value, seems to, that's a different discussion. But we can have that discussion separately.
Going back to some of the other markets, so you've mentioned the Swiss franc, and in your write-up, you were talking about CAD franc. Is that the focus for you with the franc at the moment?
So my view was that,
and pound franc as well. Sorry, you mentioned.
Yeah, the Canadian dollar versus Swiss franc. So it's just sort of grinding down, keeps grinding lower, making progressive new all-time lows. And in that kind of scenario, it's not a good market for option plays. It's a very good market for a short position, and you just use a trailing stop and you just go, fine, I'll just run it. Because it could go another 5, 6, 7, 10%, or it could just have a massive reversal. And the reversals, the bounces have been very modest. And honestly, I don't understand why people want to buy Swiss francs versus Canadian dollars at these levels, but it's the kind of thing where I don't mind getting on a trade, even if it doesn't make sense, when it has such a clear pattern. It's like, oh, fine, I'll play the pattern. And that's we'll talk about that in the class with people. It's like, yeah, you don't have to have a view per se. You can trade the pattern.
Sometimes the market's giving you a sign of something, and you don't necessarily need to have this
Yeah.
sort of your cauldron view that you're talking about. You can rely on technicals and open trades based on that.
Yeah, exactly. Like I know it's every bounce has been small. At some point, I don't know what that point of it's going to have a 10 or 15% squeeze, massive squeeze, but not yet.
And at that
Canadian,
point, would you position with options for a big move like that?
yeah, when I want to play for a big move, I'll do it. That's definitely an option. When it's, just keeps grinding lower. Euro CAD, similar kind of thing where it's different because the euro is not in demand like the Swiss franc was, although the euro is trading relatively well.
Mhm.
If you ask me for potential target, if the euro is going to rally up, I have no problem seeing it go up to 116, 117. Do I think it's justified? No, but I could see it. But that would be in a general dollar bear scenario where I would see the dollar under pressure across the board. I think in that scenario, I think the Canadian dollar will not appreciate as much. And then we see the Euro CAD, which just had this nice cycle, one up to 151, back to 142, got up to 150. Now we're having the correction back down here, 146. I still think we're going to break higher. And again, that's almost a perfect scenario for options where you put on a long option play and you basically hedge kind of extreme macro views. It gets up towards 150, 151, you put on a delta hedge. It gets back down towards 146, 147, you take your hedge off and you pay for your options. And then you wait for it to go back up again. So there are times when you can just you don't need to have a brilliant view. You just need to figure out the parameters of the market, the bands.
Something that we discuss every now and then is these thoughts on the market write-ups that you do. I think a lot of people read them and they're so used to seeing analyst write-ups where they hedge their bets and basically say it could do this or it could do that, and it's basically whatever happens is going to be right.
Yeah.
I think probably not as many people are reading your thoughts on the market in the way they should to realize that these are views that you have that you're often opening positions based on. And if they look back through the previous thoughts on the markets, okay, maybe the timing's not exactly right every single time, but at some point over the coming weeks or months, that move plays out pretty much exactly as you said, like 90, well, I know that in terms of trades, it doesn't end up being like 90% of the time, but in terms of the views on the market, it has ended up being 80 or 90% of the time that it ends up playing out, as you said. So I think people should be paying more attention to these views and not taking them as like a typical analyst prediction that where they're hedging. It's more these things actually are what you believe is going to happen.
One of the funny things, like, well, why do I do them? I write them because it actually forces me to drill down. I had the same, I wrote for Forbes for 13 years. And I did it because it actually helped me figure out my market view sometimes. There were times when I had a certain view and then I started writing about it. I said, no, I don't like this anymore. And then I would end up shifting my positions around. So it's not just some analytical process just to go fill some space. It's actually, it's an act of selfishness. I do it to help me clarify my thinking.
Speaking of the Forbes articles, again, for anyone watching this, there are some previous Forbes articles on Andy's website that you can read through as well. It's interesting actually to look back at those because, again, well, I guess your process changed over the years somewhat, but the same kind of thing. Like you look at the markets, you look at what view you had, and you can see how it played out then. And it's fascinating to see those things because these are big macro views that you have, and they're big movements in the market. It's not like you're saying, oh, we're going to have a 1% move this week. It's like sometimes 10% or like a huge move. So it's definitely something people can learn a lot from.
Look, I'm looking forward to having, starting the classes with you guys in the next few weeks. I think it should be, it'll be interesting. And I'm also, as we've discussed a little bit, I'm also looking for some people who have special talents, if you will. There are some people who are very, very good at forecasting who might be bad at trading. Might be people who are really good at trading who lousy at forecasting, and they just need some help there. Both exceptional talents can be, we're going to be looking to rebuild a prop team for our trading. So for me, this is a little bit of a, let's see if something special comes along. But regardless, I enjoyed the teaching, and I probably learned more from it than the students. So